Hey everyone, welcome to the KE Report and a company update covering what was or is some of the big news this week. A merger between Contango ORE and Dolly Varden Silver. We're chatting with both executives here. We have Rick Van Nieuwenhuyse on the Contango front. He is the president and CEO of Contango ORE. And we also have Shawn Khunkhun back on the show. He is the president and CEO of Dolly Varden Silver. Contango is traded on the NYSE American under the symbol CTGO, and Dolly Varden Silver traded on the NYSE American under the symbol DVS and the TSX Venture Exchange under the symbol DV. This is a big deal because it is bringing together two quite well-known companies. Contango ORE is already a cash flowing gold company from the Mahn Choh project. This is in partnership with Kinross, where that ore is getting shipped to that Fort Knox mill. The Contango ORE also has a couple other projects that were, from my understanding, in the pecking order in terms of next production all through this direct shipping ore strategy. Dolly Varden Silver focused in the Golden Triangle with a portfolio of gold silver projects. There's also a copper asset mixed in there, more on the exploration and I guess we can call it development front. So let's get an understanding of how this deal came together and where the merged company will go, all barring the vote going according to plan. So Rick, you're up first. I want to hear from the Contango front. Look, you're already a cash flowing gold company. You already had a couple assets, from my understanding, in the pipeline for production in the near term. So what drew you to this merger?
Yeah, it's a great question. And a lot of times mergers don't make sense. And you're sometimes I think shareholders scratch their heads on why two companies are merging. I think in this case it's a beautiful combination of assets and they're synergistic. They fit together well. I guess the way I would describe it, a few words is Contango had a great 5-year plan to grow our production from our current 60,000 ounces to 200,000 ounces. And I think combined with Dolly and the new company will be named Contango Silver and Gold, I think combined, we've got a great 20-year plan. We're developing 4 district scale projects that will see, long-term exploration upside. We're well financed. Combined, we have over $100 million in the bank, and we're generating over $100 million at current cash flows from at current gold prices from our Mahn Choh operation. So it's a 1 plus 1 is 3, or I think as Shawn has said before, it's 1 plus 1 is 11. So this is really a great launching platform for someone who wants exposure to gold and silver in North America's safe jurisdiction and with great trading liquidity and like I said, well financed.
Well, Rick, just to follow up on the pecking order here for development, with Mahn Choh already in production with Kinross as your partner, when we've talked to you in the past, I believe Lucky Shot was up next to bat, and then you've got Johnson Tract that's from the High Gold acquisition that's in development that also could be a couple years out. Does this acquisition change that batting order as far as development, or could you give us a lay of the land as far as how you envision the production profile growing?
Yeah, no, and it basically Lucky Shot is next up. I would describe it as a advanced stage exploration slash development. We've got an 18,000 meter drill program ongoing right now. In fact, I expect to be going up there in the next day or two to visit the site. So that drilling program, we expect to outline between 4 and 500,000 ounces of resource. And then from that, we'll subset a 250,000 ounce reserve, based on a feasibility level plan. And again, Lucky Shot is fully permitted as a mining operation, specifically for a DSO approach, where you're basically mining ore and then putting that run of mine material in a box and transporting it to a processing facility. And obviously, we've got a strong working relationship with Kinross, and the Fort Knox mill would have capacity to handle a relatively small amount of tonnage of high grade ore from Lucky Shot. So yeah, no change in the pecking order there. And I'm sure we'll talk more about this, but Johnson Tract and Kitsault are very synergistic in terms of how you would approach development of those assets. But I'll let Shawn get a word in here too.
Yeah, Shawn, let's get you in here because from the Dolly Varden Silver side of things, from what I see, is that this merger really gives you the cash flow to continue to advance your assets. But again, you have a handful of assets in the Golden Triangle, close to Alaska. Talk to us about the synergies that you see and how much money you think you need to put towards your projects, the Golden Triangle projects, to keep those on a, I guess, reasonable timeline towards some sort of production.
Yeah, so thanks for having me on again, guys. And I'm really excited to be here. And I'm really excited at the prospect of building a high grade, mid tier silver and gold producer and developer. From the Dolly Varden perspective, we've been on a journey, and that journey has seen us make 5 acquisitions. We've made numerous discoveries. We've built an inventory that's really unique, high grade silver complemented by high grade gold in the Golden Triangle. But as I look to daylight these projects, I've been in the mining industry now for 22 years, and there are companies that made discoveries when I started 20 years ago that are still not in production. And when I started studying Contango, and I saw this direct ship ore approach where you're not looking to build a processing facility. You're not looking to permit tailings. I thought because of underutilized facilities in the area, I thought this could be an approach that we could use at the Kitsault Valley. But I needed a well-funded partner. And because Contango has the JV with Kinross, and they have the Mahn Choh gold mine in Alaska that's spitting out about $100 million of free cash flow, and these are US dollars, and the combined company will have about 100 million US in pro forma cash. I thought this was the perfect opportunity to complement production, a development pipeline with exploration upside. And, being a student of the capital markets, size matters, increased trading liquidity, index inclusion, all the institutional ownership. And, as Rick and I, we probably met about 10 years ago, but we really got to know each other over the last 6 months as we did due diligence and we looked at shared vision, and we tried to understand the chemistry, not only the projects would have, but also the people. What the things that stood out here where Contango has done a really good job of bringing in Franklin and Alyeska and some incredible institutional shareholders, and so has Dolly Varden, but they're different. And there is no cross-pollination. So there's real opportunity here for the Contango shareholder to get exposure to silver. There's an opportunity here for the Dolly Varden shareholder to get exposure to production and leverage that production to develop our projects.
Well, Shawn, just to follow up on the very large drill program you had this year in 2025 and moving forward, you've been stepping out and testing the periodicity of the project at Torbrit, at Wolf, at Chance, at Moose. There's still a lot of action in the Homestake part of the project on the gold and silver side. You're already a pretty balanced company between silver and gold, but maybe just put into context how this production profile can help you hit the accelerator on exploration.
I think there's not only is it going to allow us to hit that accelerator, as you put it, but there's something that we're lacking in the current company, which is the skill set to move from exploration through development and into production. And it's not only the balance sheet, the cash flow, it's also the expertise. And so, we've been very successful. And, what I really celebrate is Rick is CEO of Contango. He's also a geologist. And I think when he came to site and he looked at our core and he looked at some of the drill results that have been coming out, not only on the silver side, but also on the gold side up at Homestake, I think, and I don't want to put words in his mouth. Maybe I'll turn it over to Rick. The rationale that he saw both on an expansion and extension potential, that Golden Triangle geology is quite unique. But Rick, maybe I'll let you comment on what your thoughts are on the Kitsault Valley.
Yeah, I mean, we obviously have done a fair bit of due diligence on each other's assets, and I have to say, going to see the core and see the the layout of the, sort of boots on the ground layout of the land. Very impressed with the setup there. Very impressed with the exploration team. And there's nothing like looking at core. And we happened to be there when they'd finished drilling and put on the racks. I think I don't remember the number of the hole, but it was a high grade hole that I think has been now since been released. But when you see, the strength of a mineralized system, you can, good geologists can tell that, okay, this is real. This is not just a bunch of, this isn't low grade stuff that has a hard time hanging together. It's consistently drilled. So I really look forward to the synergies between the two companies and the people. I think mixing our exploration people, our exploration, all the individuals involved, and getting that cross synergies and cross pollination with the two teams. I think we're going to see huge benefits out of that as well. Nothing like taking a bunch of geologists and taking them to a new property and saying, okay, well, yeah, let's get some new ideas flowing here. So I'm really looking forward to that aspect of this combined company as well.
And I'll just say one other thing just to sort of, pull on that thread. My experience in the business is, working with serially successful entrepreneurs, you are who you surround yourself with. And, I know working with Frank Juster and the Fiore Group for the last few years, I've seen what that's done to my career. And, an opportunity to work with Rick, who was the founder of Nova Gold, Trilogy. I'm really looking forward to getting behind him and Mike Clark and exposing our large shareholder base to the Contango opportunity. And then again, we now qualify. Like, I've modeled that once the shareholder vote happens and the two companies come together in March, there's going to be about $50 million of USD buying from the ETF and indices. So there is some direct benefits from putting these two companies together. Size and scale gets rewarded in our markets. And this is the first of many deals to come. First step, shareholder vote. Second step, share the value proposition so the re-rating occurs. But Rick and I have a list of the next assets that we want to bring into the company.
To that point, Shawn, can you square up for me just how many projects even Dolly Varden has? You have just been on an acquisition tear since 2022 when you acquired Homestake Ridge project from Fury. Then in 2024, you got the Big Bulk property from Libero. And then in May of 2025, you acquired a project from Hecla. May in 2025 again, you got the Porter Silver project from Strike Point. Then you also acquired the portfolio from MTB Metals. That was also in May 2025. And on top of this, you already had the Dolly Varden project. So even before you start acquiring other projects, can you square up with me where you're going to focus when you have this large of a portfolio?
Well, it's a great question. And, I've been studying successful mining entrepreneurs. Rick's one of them. There's a few in the Golden Triangle, Bob Quartermain, Walter Coles at Skeena. Skeena has gone from 30 million to 3 billion in market cap, and they've made a lot of acquisitions along the way, but their focus is SK Creek. And despite building a large land position, we have opportunistically, accretively enhanced the mines that we have under ownership and the acreage of prospective Hazelton Jurassics in the Golden Triangle. But 99% of our focus has been drilling two deposits, Wolf and Homestake. So the idea was we were in a time, and we haven't made an acquisition since May. We were in a moment in time with silver sub $25. Gold was significantly lower than it is today. We went out and took advantage of an opportunity where equities to commodity prices, the disparity had never been greater. And so we used our shares to acquire, but we've been focused and we've got a very, very healthy treasury. So the good news here is, we've got enough capital and again, with the production and being well funded to organically grow and develop the portfolio. So we're focused on a very, very a small part of the land package. It represents about a 5 kilometer trend. We're focused on about 10,000 hectares of 100,000 hectare package, which means, we have about 90% of the portfolio that has yet to be explored, but we'll systematically continue to focus on expansion, extension, and continue to look for discoveries.
Well, Rick, I want to field this one to you, but also maybe have Shawn weigh in on it. The model that the company is going after is a continuation of what you've already been doing at Mahn Choh with the direct shipping ore process. That's how you envision things going for Lucky Shot. Is that also how you envision things going for Johnson Tract? And then maybe Shawn can weigh in on how the DSO model could work because of their road access and deep water port. So maybe let's talk, for people not familiar with the direct shipping or model, the advantages of it, and if that's going to be the theme of the company.
Yeah, certainly for the time being, that's definitely the theme of the company. And what we've demonstrated with Mahn Choh that the DSO model works, the direct shipping ore model works. So basically, you're mining ore on site. It's high enough grade that it can forward the transportation to an existing mill facility. In the case of Mahn Choh, that was the Fort Knox facility. It had excess capacity, so we worked out a deal with Kinross to process the ore there. And that's what's generating 60,000 ounces of gold for the company and roughly $100 million of free cash flow. Now, there's certain criteria that has to be met to be able to make money with a DSO model. It has to be high grade. It has to be near infrastructure, near existing infrastructure. Otherwise, you've got to build that infrastructure yourself. You don't need a lot of infrastructure because you're not building a mill and a tailings facility, so you don't need a big power plant. And then it also has to be, the mine still has to be permitted. And it's a very small footprint when you think just of an open pit or underground mining quarry. There's not a lot of things that you have to do to permit. And in the case of our existing assets in Alaska, all three of our assets, Mahn Choh, Lucky Shot, and Johnson Tract, are located on private land. And in the United States, private land is by far the easiest land to be able to permit a mine on, especially when you take into consideration that you're not building a mill, a power plant, and a tailings facility. So ease of permitting is part of that. And existing infrastructure goes a long ways in that. And being close to water is another one. So in the case of Mahn Choh, we've demonstrated the model works. The criteria, high grade, close to infrastructure, and relatively easy to permit. We all know nothing's easy in the mining business, but relatively. And so Lucky Shot fits that. We're 20 miles from the Alaska Railroad. We can put rock, we can mine the ore, and it's high grade. The resource grade is about 14, 15 grams. We expect a mine grade of, something closer to 10 grams, but that's plenty of money to be able to put that rock in a box and haul it up to Fort Knox and make money with. Johnson Tract, much bigger system, but similarly high grade. It's just shy of 10 grams gold equivalent. It's a critical metals project. We've put it on the Fast 41 timeline for permitting. So now we have a coordinated, permitting effort supported by the federal government. The U.S. Army Corps of Engineers will be our lead federal agency. So because it's close to water, it's on private land, it's close to water. So, and we have our easements already granted by the federal government to access the water with a road down to a port facility. You've got to build the barge landing facility, but once it's on the water, that's the cheapest form of transportation. So that's the Contango side. And as I mentioned earlier, Johnson Tract and Kitsault Valley are both sulfide deposits. They're going to be processed at a similar kind of facility. And that's a good segue over to Shawn and explain it from the Kitsault side.
Well, no, I'll just, reiterate some of the points you're making here. Like, looking at the Mahn Choh operation and having those covered sealed containers with no fugitive dust coming out, not having to build and monitor a tailings facility, no mill. Not only do we celebrate the Kitsault Valley from a CapEx standpoint, but the fact that there is multiple underutilized facilities that are out there that are hungry, that are idled. It makes no sense to permit and to build new facilities. So because we are high grade, we do fit that DSO approach. So, there's a lot of things that we have consistent here with the two companies. Obviously the geographical consistencies, but there are also consistencies in the high grade nature of the deposits and the fact that they're in neighboring territories and provinces.
So looking ahead here then, Rick, I guess I'll throw this to you. As of right now, as you said a couple times here, generating, let's call it around $100 million per year through the Mahn Choh operation. Next up would be Lucky Shot. I think Mahn Choh is not a long life asset for you. So take us through how we can forecast production, probably not on the dollar amount, but ounces out of the ground that would generate revenue for you, what the time frame looks like for that. And then on the back end of that, when you can bring in some of these Dolly Varden projects, which are still earlier stage, when you would look into, it sounds like not building your own mill, but acquiring something.
Yeah, so we'll start with Lucky Shot. So as I mentioned, 18,000-meter drill program ongoing right now. Most of that is underground, so it's something that can be done year round. We'll have a bit of surface drilling we'll do next summer when the weather's better, and we expect that to outline a 400,000 to 500,000 ounce resource, and then subset that into a 250,000 ounce feasibility mineable deposit using the DSO approach. So it'll cost about $50 million to execute that program and take about 2 years. And within that time frame, you should then be in a place to make a mine construction decision. And again, you're not building a mill in a tailings facility, so it's kind of just a go-ahead decision. Yeah, let's start putting the infrastructure in place to start mining, meaning stope development and stope access. So it's not a lot of money. Basically, the $50 million is broken down, rough numbers, have to get all the underground development and drilling in place, and then have to put your stope development and access in place. So $50 million to generate, say, 30,000 ounces at startup, and maybe over time, over a course of a year, increase that to 40 or 50,000 ounces. All in sustaining costs, we're guiding towards 1,500. So you've at $3,500 gold, you got a $2,000 margin, and so at 30,000 ounces, you're generating $60 million of free cash flow with those metrics. Obviously, higher gold price, it goes up, and for not a lot of cash flow. Johnson Tract, it's a similar development profile to Lucky Shot. It's just about 2 years behind in that we've got to permit the underground access, which we're in the process of doing right now. And we expect by Q1 of next year, we'll have the permits to go underground. So we'll get that work started next year. It'll take about a year to do the underground development, and then about another year to complete all the drilling to complete a feasibility study. So you can see it's just basically 2 years behind Lucky Shot. And then that kind of leads you over towards, in a parallel fashion, at least in terms of the timeline with Johnson Tract, we can be advancing the Kitsault assets. And again, there's four or five different projects in Kitsault Valley that, as Shawn has described, sort of pearls on a string. You don't need to start all five of them at once. I would say you start with, you look at Torbit, the road goes to Torbit. It was a mine, so it's a brownfield site. And again, from a permitting standpoint, that makes things easier. It's kind of a mine restart if you think about it. So that's how I see this playing out over the next 5 years.
Well, Rick and Shawn, just some final comments here as we wrap up, and it's on how to value this new pro forma company. I know that's a difficult question to ask, but maybe you can summarize the value proposition, the multiple you should get, because you're kind of a hybrid between a producer, a developer, and an explorer all at once, which is a nice diversification. But how should investors looking at this new combined juggernaut value the company?
Well, I can step in here, Rick. Discovery Silver, which trades at about a 0.9 multiple, did something where they were anchored with a silver project in Mexico, and they got into production in Ontario. They're now valued at $6 billion at a 0.9 multiple. That would be on the higher end of the valuations. We're going to start trading at about 0.5 based on our net asset value. So I think there is a major re-rating potential. There's a lot of producers that are trading closer to that one NAV multiple. I think there's a number of opportunities within the portfolio. I think if we looked at a spot gold valuation just on Johnson Tract. Rick, and you can confirm this, the NPV is what, $600 million at spot gold?
That's correct. Actually, higher than that spot, but yeah, we did a $4,000 gold. So yeah.
And it's got less than a 1 year payback. So, when I look at this company today, when I look at Contango, I think just the Johnson Tract alone could justify the current valuation. And I think one of the challenges investors have today is liquidity, index inclusion, right? And just that greater scale. So I think by bringing these two companies together, there's most of the world can finally buy it. And I think that's the big opportunity. That's the re-rating. And then I think there is enough value throughout the portfolio to justify, a 1.5 to $2 billion valuation. And then I think once we get there, we should start looking further afield at other operating opportunities to bring in and to continue to grow.
All right, guys, we're going to wrap it up here. Thank you so much for fielding these questions. Hopefully, we shed some more light on this merger. Again, Rick Van Nieuwenhuyse, President and CEO of Contango ORE, and Shawn Khunkhun, President and CEO of Dolly Varden Silver. For everyone listening, if you have more questions, please email Shad or I, and we will get those addressed. We'll follow up with this team as the deal gets closer to closing and to address all of your questions. Everyone, thank you for your time, and thanks for listening to this Daily Editorial.